Talking about some of the issues that we deal with when we're accounting for income taxes. Those issues vastly are going to depend a little bit on whether something is permanent or it's temporary. First and foremost is the formula that we use to compute our income tax expense for the income statement presentation. Is income taxes payable or refundable, plus or minus any change in our deferred income taxes, result in either an income tax expense or a benefit. In our income statement, typically as a note to the financial statements, you're going to find any disclosures related to significant components of the income tax expense, whether they're current or deferred, and you may find a reconciliation of the income tax expense and the income tax payable accounts. So here we see how Chelsea has, within the income statement, disclosed how much of the income tax expense is current and how much of it has been deferred. So the deferred amount is going to be recognized on the balance sheet. Differences between income tax from the taxable side and then from the accounting side arise from either temporary or permanent differences. Temporary differences originate in one period. They turn around in reverse in another or subsequent period. So, for example, when companies accrue product warranty liabilities and expenses, for accounting purposes, we recognize those in the current period, but not for tax purposes. In the future, as those warranty liabilities are settled, they become tax deductible amounts. And that results in the reversing of the effect of the original timing difference. When there is a taxable temporary difference, then we get a deferred tax liability. And when there's a deductible temporary difference, then we're going to get a deferred tax asset. So let's look at what some of those temporary differences are. When revenues or gains are taxable after they're recognized in financial income, we would have an asset which may be recognized for revenues or gains that will result in taxable amounts in future years when the asset is recovered, such as sales accounted for on the accrual basis for financial reporting purposes, and then on an installment cash basis for tax purposes. Contracts that are accounted for under the percentage of completion method for financial reporting, and a portion of the related gross profits is deferred for tax purposes. Investments that are accounted for under the equity method for financial reporting purposes, but underneath the cost method for tax purposes. Gains on involuntary conversion of non-monetary assets, which are recognized for financial reporting purposes, but are not deferred, but are deferred for tax purposes. So they're not recognized for tax purposes in that year. Unrealized holding gains for financial reporting purposes, including those from the fair value option, are deferred for tax purposes. So that one should be relatively fresh in your mind when we're talking about investments, stocks, and bonds. Now, there are some expenses or losses that become deductible after they're recognized in financial income. So a liability or a contra asset may be recognized for expenses or losses that will result in deductible amounts in the future when the liability is settled. As I said just a few minutes ago, there's product warranty liabilities. There's estimated liabilities related to discontinued operations or restructurings. Those litigation accruals, we've talked about those a little bit. Bad debt expenses recognized using the allowance method for financial reporting purposes. We have to use the direct write-off method for tax purposes. Stock-based compensation expenses. Unrealized holding losses for financial reporting purposes, including the use of the fair value option, but that's deferred for tax purposes. Some revenues or gains are taxable before they're recognized in our financial income. A liability may be recognized for an advance payment for goods or services to be provided in future years. So, for example, we receive a deposit. For tax purposes, the advance payment is included in taxable income once we receive cash. Future sacrifices to provide the goods or services, or future refunds for those who cancel their orders that settle the liability, result in deductible amounts in future years. So things such as subscriptions received in advance, advanced rental receipts, sales and leasebacks for financial reporting purposes, but reported as sales for tax purposes, prepaid contracts, royalties received in advance, things of this nature. And some losses that are deductible before they're recognized in financial income. The cost of an asset may have been deducted for tax purposes faster than it was expensed for financial reporting purposes. Amounts received upon future recovery of the amount of the asset for financial reporting will exceed the remaining tax basis of the asset and therefore result in taxable amounts in future years. So this is things like depreciable property, depletable resources, intangibles, deductible pension funding that's exceeding the expense, prepaid expenses that are deducted on the tax return in the period that's actually paid in. Some of the big differences between accounting and tax is that tax is definitely on a kind of a modified cash basis because it does use some concepts of accruals such as depreciation, but it uses them slightly differently than we use them in accounting. But many of the other things are related to when the cash was received or when the cash was paid out. So the concepts that really tie to our temporary differences are originating and reversing aspects. An originating difference is the initial temporary difference between the book basis and the tax basis of an asset or a liability, regardless of whether the tax basis of the asset or liability exceeds or exceeded the book basis of the asset or the liability. Reversing differences, however, occur when the temporary differences that originated in a prior period is eliminated and the tax effect is removed from the deferred tax account. So, for example, we're looking at with the originating one, it's there much longer, whereas with the reversing one, that particular difference will clear out in a later period. Permanent differences happen when items are entered into the financial income but never into the taxable income, enter into the taxable income but never into the financial income. Some examples of permanent differences are interest received on state and municipal obligations, proceeds from life insurance on key executives, such as key man policies, fines and expenses resulting from a violation of the law. These items are not computed in the computation of taxable income, and the profession has concluded that the tax consequences of these differences should not be recognized. These types of differences will only affect the period in which they occur. They do not give rise to future taxable benefits or deductible amounts. There are no deferred tax consequences that should be recognized when these occur. So some examples of some future some permanent differences. As we said, interest received on state and municipal obligations, expenses incurred in obtaining tax-exempt income, proceeds from life insurance on key officers or employees, premiums paid for life insurance carried by the company on key offers or employees in which the company is a beneficiary, fines and expenses as the result of violations of the law, items that are recognized for tax purposes but not for financial reporting purposes are the percentage depletion of natural resources in excess of their cost, the deduction for dividends received from U.S. corporations, and that's usually 70 or 80%. Excuse me. So, with some specific differences. If there's a future deductible amount, it's a deferred tax asset. If it's a future taxable amount, it's a deferred tax liability, or it's a permanent difference. We know that Maker's depreciation system is used for tax purposes, but when straight line is used for financial reporting purposes, in that particular instance, is that a future taxable amount, a future deductible amount, or is that a permanent difference? That is a future taxable amount. When a landlord collects some rents in advance, rents are received are taxable in the period in which they're received. That's a future deductible amount. And then expenses that are incurred in obtaining tax-exempt income. That would be a permanent difference. That's not going to reverse in a future period. So let's look at a couple more of these. Leave them up for a second for you to read them. And then let's see whether they are future deductible amounts, future taxable amounts, or permanent differences. So costs of guarantees and warranties are estimated and accrued for financial reporting purposes. You'll recall that from a prior class. What does that result in? A future deductible amount. Installment sales of investments are accounted for by the accrual method for financial reporting purposes, and then the installment sales method for tax purposes. What is that going to result in? And then proceeds that are received from a life insurance company because of the death of a key officer on a policy in which the company carries it on that person. Let's go a little deeper and look at an illustration by Havachi Company, who reports pre-tax financial income of $80,000 for 2017. They have these three items which cause taxable income to be different than that of pre-tax income. Depreciation on the tax return is greater than depreciation on the income statement by $16,000. Rent collected on the tax return is greater than rent earned on the income statement by $27,000. And fines for pollution appear as an expense of $11,000 on the income statement. Havachi's tax rate is 30% for all years, and the company expects to report taxable income in all future years. There are currently no deferred taxes at the beginning of 2017. So let's go into using a columnar spreadsheet type of situation. We start with our financial income for the current year. We have to remove excess tax depreciation. We need to add the rents collected. And then we need to add back those fines that are permanent. That's going to give us taxable income of $102,000. So a 30% tax rate, the amount of income tax that we will remit to the IRS is $30,600. That's $16,000 of excess tax depreciation. So we're taking it now. Means that we're going to have to see it as a liability. The excess rent collected, we've collected the rent, but we haven't recognized it as income, gives rise to the benefit in future years of $27,000 that will be deductible from our financial statements to determine our taxable income. And then the permanent fines don't impact a future period. They impact only this period. So we do not recognize them any further. That gives us deferred tax assets of $8,100 and deferred liabilities of $4,800. So we recognize $8,100 as an increase in the deferred tax asset. We recognize $4,800 as an increase to the deferred tax liability. We have income taxes payable of $30,600, giving us a plugged amount of $27,300 for our income tax expense for financial reporting purposes for the current period. Now, there is one little area where things can really get unusual, and this happens not all of the time, but can happen more frequently than not. And that's a change in future tax rates. Corporate taxation is very complicated. It's a specialized section of income tax accounting. When the code changes or there has been something that has impacted a future tax rate, the company has to take into consideration what those changes and laws and rates are, and what their impact is going to be in future years to the existing temporary differences. So we already have a deferred tax asset, a deferred tax liability on the books, and something has occurred and triggered a change in our future tax rate. In determining the appropriate enacted tax rate for the years, the company uses the average tax rate. So when that change is enacted, we record the effect of it on those deferred accounts in that year. So the year that the change happens is when we actually recognize the change on the balance sheet, and we report the effect as an adjustment to our income tax expense in the period of the change. So as I said, this can happen frequently depending upon what the company is doing. If a company is in a period of growth, so their tax rate may be changing more rapidly than a company that is in a period of stability, then we would see this happen more often. Whereas when this is the result of something such as a change in the tax code, a company has sat at a 30% for many years. They're very stable. They tend to have the same amount of income, the same amount of expenses. This isn't going to really change anything. But then something widespread changes in tax law. When that happens in that year, the company adjusts their deferred tax assets and their deferred tax liabilities and recognizes the effect as a component of their income tax expense in that year, because that is the trigger year. We're going to continue moving forward in another video, and in that video we'll talk about things like loss carrybacks and loss carryforwards. So what happens when a loss is incurred?